Hey, welcome back. It's JWalter here. In today's video, I'm going to share a press release from Fannie Mae because they just revised their economic and housing market forecast through 2022. And they actually downgraded their forecast. So that's the topic of today's video. If you get any value out of this video, then please hit the like button. Let's go ahead and dive right into the video though. This was just announced on the 17th of March, and the headline reads, "Inflation and Russia's invasion of Ukraine expected to take a toll on the U.S. economy and the housing sector." So let's dive right in here. It says the Russian invasion of Ukraine and its implications for the global economy has added to growing inflation pressures and ongoing supply chain difficulties as monetary policy tightening begins. As you guys all know, the Federal Reserve announced they're going to increase, or they have increased, the federal funds rate by 0.25%, and they are anticipating to increase the federal funds rate in each of their meetings this year. More on that here in just a little bit though. According to Fannie Mae's Economic and Strategic Research Group, or the ESR group, that group projects full year 2022 real GDP growth of 2.3%, and that's down from the previous forecast of 2.8%. So they downgraded the GDP growth in the US due to all these issues we have in the world right now, and also inflation, of course, as well. Prior to the conflict, inflation, as measured by the Consumer Price Index, or the CPI, hit a 40-year high, and the Federal Reserve was posed to begin a course of significant monetary policy tightening. So prior to this conflict in the Ukraine, they were forecasting to increase the federal funds rate by 0.5%. Because of these issues in Ukraine, they actually increased it only by 0.25%. So in other words, rather than doing a 0.5% interest rate hike, they only did a 0.25% hike due to all these conflicts here in the Ukraine. Despite the substantial uncertainty, this group continues to expect the Federal Reserve to raise the federal funds rate 5 times in 2022. and 8 times total through 2023. As you guys all know, I talk about this all the time, but the federal funds rate is not tied directly to mortgage rates. The Fed does not control mortgage rates. However, there is a loose connection between the federal funds rate and mortgage rates. So when the federal funds rate increases, so can mortgage rates. I'm going to be going over the latest mortgage rates here in just a little bit. They say all this above is expected to impact the housing market. The group increased its 30-year fixed rate mortgage rate forecast to 3.8% in 2022 and 3.9% in 2023 due to the likely upward impact of Fed monetary policy tightening. In other words, they're not buying mortgage-backed securities and they're increasing the federal funds rate. So they're forecasting overall in 2022 that mortgage rates are going to be at 3.8%. I'm kind of scratching my head over this because when you look at rates right now, rates have increased 1.64% year over year. So they started the year off at 3.36%. And as of Friday, March 25th, we're at 4.95%. So they've absolutely skyrocketed, especially over the course of the past few weeks. So I'm wondering if they're going to be revising this once again because rates are already at almost 5%, and we haven't even hit April yet. In any case, they say combined with the lower economic growth forecast, the group downgraded its housing outlook and now expects total home sales to decline 4.1% in 2022 compared to the 2.4% decline that they forecasted last month. In my opinion, we would have to have a big increase in housing supply in order to cause home prices to decrease. However, I do believe we'll have a decline in home sales due to the fact that we have home affordability issues as home prices have been increasing and also mortgage rates have been increasing as well. In addition, I also expect home sales to be in low levels because I believe that a lot of people like myself who have mortgage rates of less than 3%, why would we sell our houses to get a 5% mortgage rate unless we really need the money out of our houses, right? So in my opinion, I think a lot of people are not going to be motivated to sell their houses given they have a 2.6% 30-year fixed rate mortgage, and now prices have increased so much and also rates are near 5% right now. It's my personal opinion. We'll have to see if that comes to fruition because as you guys know, I'm not a real estate market fortune teller. So Doug Duncan, who's Fannie Mae's vice president and chief economist, stated the following: a slowing economy, decades high inflation, 40-year high, expired fiscal stimulus, tightening monetary policy, and now Russia's invasion of Ukraine are all weighing on the health of the U.S. economy. The interruptions to the trade of energy, agriculture, and other commodities are putting upward pressure on inflation, making an already difficult task for the Federal Reserve even more challenging because they can't suddenly increase the federal funds rate by 1%. Otherwise, that's going to cause havoc amongst our U.S. economy and also, of course, the housing market. Housing is currently acting as support to an otherwise slowing economy, although it is adding significantly to inflation. Supply is supporting new construction and sales as well. As you guys all know, we have a lack of supply of existing houses, and that's one reason why home builders are ramping up construction of brand new houses, albeit at a very small level though. There is an increased risk as rates rise though, but this may be offset by real estate being a hedge against inflation. He continued by saying, we expect home purchase volume to hold up reasonably well, but refi activity to fall off the cliff basically. Perhaps totaling only a third of all originations unless there's a drop in mortgage rates, which they do not expect. I also do not expect that as well. And speaking of purchase volume, let's have a look at mortgage applications numbers. So the latest we have is from the Mortgage Bankers Association. They just posted this 2 days ago. They stated that mortgage applications decreased 8.1% from 1 week earlier, and this is for the week ending March 18th. So mortgage applications are broken up by refis as well as purchases. So the refi index decreased 14% from the previous week and was down 54% lower than the same week 1 year ago. This makes sense given the fact that mortgage rates have been increasing. So of course, the amount of people who want to refi is also going to be decreasing as well. The unadjusted purchase index decreased 1% from the previous week and was down 12% from the same week 1 year ago. Meanwhile, the MBA's new March forecasts expect mortgage rates to continue to trend higher through the course of 2022. And the refi share of mortgage activity, these are mortgage applications, decreased to 44.8% of total applications. If I'm not mistaken, about a year ago, this made up about 60% of all mortgage applications were refis. Nonetheless, from a historical perspective, mortgage rates of around 4% for a fixed rate loan is still a consumer-friendly rate for a home purchase. However, I wonder if they would say if 5% is. So have a look at this. Over the course of the last 5 years, right now, again, 4.95%, we haven't seen rates this high since basically November of 2018. A key takeaway for you regarding mortgage rates, though, is that in 2018, it took approximately 1 year or about 11 months for the 30-year fixed rate mortgage to increase from 4% to 5%. It took almost 1 year. Now it has increased about 1% in the last 3 weeks alone right now, which is absolutely insane. So comment below with your key takeaways from today's video. Also, if you got any value out of today's video, then please hit the like button. I greatly appreciate that. And also check out that link below if you're looking for a real estate agent referral in your neck of the woods. Hope you have an awesome day and look forward to seeing you on the next video.